Hello, everybody. Today we will be comparing the different companies that are in the fast food industry. I know there's a couple smaller ones, maybe some that aren't publicly traded companies, but just three that I believe everybody knows about, and different sizes, but something we can still compare relatively because they're all fast food chains. So first up we have McDonald's, which doesn't need an introduction. Everybody knows McDonald's ever since they were a kid. Obviously the largest one of the three. The second one is the smallest of the three. We'll be looking at Wendy's. And the third one is Restaurant Brands International. And if you don't know, it is a merger between Burger King, Popeyes, Tim Hortons, as well as Firehouse Subs. So, first up, we're going to look at the biggest one. We'll look at McDonald's. So, obviously, biggest one by market cap, 200 and just under $213 billion market cap. We'll scroll on down. You can see on a quarterly basis doing 6 billion in revenue, 2 billion in net profit or net income. We can see most of these are slower growth, so you can see 1% growth, and I would say it ranges between 1 to 2.5%, but still very profitable and very consistent. Scroll on down, look at the balance sheet. You're going to see a negative price to book because these are heavily debted companies. Most of these are franchised. I believe McDonald's owns more of their locations, but they're still, I believe it's at least 80% franchised. Wendy's is, I believe, quite close to 100% franchise, and Restaurant Brands is the same. Just, I would say, 95% are franchised, if not more. So, McDonald's, if you've ever seen the documentary about Ray Kroc, he says, there's a famous line, he says, "You're not in the burger business, you're in the real estate business." And he says that for good reason, because McDonald's owns the land and they lease it out to the franchisees, so they collect the fees, which has done tremendously well for them. We can see 15% return on capital, which for a fast food chain is quite nice. And we'll look over on the trading view just to get a better picture. You can see it trades for quite a premium, 25 price to earnings. Historically, can seem cheap. It's been coming down slightly over the last couple years, but that can also range due to profitability, which if we look a little bit lower, we will see profitability is not a problem for McDonald's. 30% net margin, quite consistently. 26%, but 24%. So 20 to 30%, but still, that's quite good. Again, we're paying a little bit of a premium. 8 price to sales ratio is a little bit rich. You can see franchise owned and a couple they own themselves. We can see international, United States, and license marketing. 60% dividend payout. I'm also going to make a note of the dividend since some people are interested in the dividend. I know Wendy's has a much bigger dividend, so we'll also compare those. 2% is not too bad. I'd be a little bit more concerned if it was over. I think the danger zone for dividends, it always depends on the company, but 60% payout ratio is not too bad, and 2%, it's not too bad either. Next, we'll look at the balance sheet. We can see very heavily debted, but for good reason. They're owning real estate. We can even look quarterly. See, it definitely fluctuates, but they still have enough cash. We're going to go over to statistics. Check annually. We're going to look at common shares outstanding. You can see a slight, well, I want to say slight decrease, but then it takes a bit of a jump the last couple of years, which is always good for the shareholders, as well as float shares outstanding. Talked about the PE, we talked about the price to sales. A little expensive, but it seems to average around 8. Price to book, remember it's negative because they have more liabilities than assets. Next, we're going to look at return on invested capital. It's been slightly decreasing, but still 17%. Last year was quite good. Gross margin above 50%. That's pretty good. Again, we will compare that to the others to see. Operating margin about 40-ish. Still quite nice. And come down to our net margin, like we looked at before, 30s, high 26, 25-ish that one year, but still pretty good. So next we're going to look at Wendy's. Now remember we looked at McDonald's, that market cap, $213 billion. And when we look at Wendy's, $2 billion. What's the difference? Well, McDonald's is international. I'm pretty sure they're in most countries around the world. But Wendy's focuses only on North America. So, yeah, I think the description's very slim here, but they tend to just concentrate their focus, and I mean, there's nothing wrong with that. They do what works for them, and they stick to that plan, so who am I to say that's not a smart strategy? But we can see if their numbers slowly increasing, again, that 2 to 3% revenue increase, not awful, but gradually increasing, as well as net income. It varies, but still making a profit. It's nothing to sneeze at. And we'll look at price to book, a little bit higher, but not negative, but still very close, very in line. We'll look at return on capital, 5%. Now remember, McDonald's was 15%, so remember, you're paying a premium, but you are paying for a better brand. And then we'll look over on the trading view. We can see they do own 9% of the outstanding shares, which is nice. I do like to see that. I like to know that the company I own has some skin in the game, that they're not just making decisions without it directly affecting them. But we can see a decline, a really rapid decline, as well as if we look at the share price in the last 5 years. And one thing that kind of caught me off guard was a bit of a roller coaster ride in the share price. So we don't have to go back historically, but you can see around 2008, just 80% decline in the price. In the last 5 years, they've been pretty consistent. Couple drops during COVID, but ever since that high, a 50% dip. So I mean, this could be one of those recovery stories, because I mean, as we said before, the stock price is not the business. As we can see from the last 5 years, we can look at before COVID on the trading view, but revenue keeps increasing, so it seems the business is okay. Back to the trading view, we can see 12 price to sales. That's quite cheap in comparison to McDonald's. I believe it was 25, and the P price to sales was around 8. So you're trading 1, which, if you can recall from my last video, I said 2 to 7 is that sweet range on price to sales, so this looks very attractive. So one thing I like to see is last year they made $12 billion, and I know we're not talking about costs, we'll get to operating margin soon, but revenue equals to market cap, so exactly 1 price to sales. can see net profit margin, 9%, 8%, 10%, 6% depending on the year, so single digit, but depending on the year, they can definitely make it a little bit better. Here's where it gets our first red flag, 100% payout ratio, so this is definitely going to affect you a little bit. The dividend, just under 8%, so I like to just weigh on the side of caution because it is a very attractive dividend yield, but dividends are always subject to change. If the business, if they have a bad quarter or a bad year, that dividend is always subject to get slashed or removed entirely, so you have to take that into account. You can look at the balance sheet. They do have some cash, but you can see where a lot of that cash is going to that dividend yield to support it. And you can see with the falling share price, remember we see it over the last couple of years, keeps declining slowly, and inversely, that increases the dividend yield. Now we will go over to statistics, switch it to annually. One thing I see right away, they're doing the same as McDonald's. They're buying back shares, which is exactly what we want to see. We don't want to see them issuing new shares and diluting the shareholders. You can also scroll on down, see price to sales. This was 2018, so we can see it throughout COVID, how it fluctuates. And that, again, can be skewed with profitability. We can see price to sales. It's the cheapest it's been in a very long time. So this could be a very good opportunity. Price to book. Excuse me. It is slightly expensive. Obviously, we talked about before being a very high debt business. So price to book can be skewed, but just something to keep in mind. So, we'll look at return on invested capital. I was going to say steady at 5%, but good year here, not so good the next year. Go to gross margin, 30%, I want to say on average. Not the greatest, but not too bad at all. Really wouldn't complain about that. Operating margin percentage, 16%. Average, a little bit lower this last year, but very good. We'll look at net, 30%. Wow, that was a wicked year. That's really good. 6%, 10, 8, 9. So, not terrible. Single digit net profitability. I would like to see that a little bit better, but cannot complain for such a, I would say this could be a very deep value buy. But again, we have to be careful about that dividend yield. I mean, I know some people, they invest specifically for dividends, but you want to keep into account appreciation as well. Like I said, if you want that dividend yield and it gets slashed, that can definitely damage your returns. So just something to keep an eye out for. And we'll move to our last one. We will look at Restaurant Brands International, ticker symbol QSR. And it is the American version. There's also the Canadian version, which is what I'm looking at here. So I'm actually going to switch that. Just so we're looking at the same numbers. Okay. Market cap, $22 billion. Dividend yield of 3.6%, so within our range, so if that's what you're looking for. We'll look at revenues, and look at that, 20% revenue increase year over year. Wow. Look at that, as well as, let's look at net income. Look at that, every year increasing. Boom. Oh, slight decrease, but comes back up this year, so I like the way that's looking. Off to the balance sheet, price to book, Actually, a 4, that's quite nice. So it's a little bit, the size is in between, but you kind of get the best of both worlds. As we'll see with the 7% return on capital, it's quite nice. And we'll get over to the trading view. They own a little under 2% of the company. Valuation, we'll see. Price to earnings has sloped a little bit, but price to sales just under, well, okay, 3.3. It's not terrible. It's within our range, so could be a good opportunity. Net margin has come down a little bit, so that's where you can see the price to earnings fluctuate a little. But still, quite good revenue increase, and you can see that almost half their business from Tim Hortons alone. If you know how popular Tim Hortons is in Canada, there's always a line around the block in the drive-thru. People love their coffee and love their donuts, so as well as they're a little diversified. So you got your Burger King, their holding company International, Popeyes. I'm sure Firehouse Subs isn't one of these. I would say it would be restaurant brands. And you can see the United States is their biggest. Canada's next. And I believe that's International. I believe they have a couple restaurants. Coming down, we look at the dividend yield again, just under 4%. 81% payout ratio, that's a little on the high side, but still comparing to Wendy's that was over 100%, just something to be aware of. And looking at the balance sheet, debt has been, it took on a little more debt, maybe expanding, buying another location, but they do still have some cash and some cash flow, so nothing to worry about there. Alright, we will go look at the statistics. Alrighty, now here's where I see a little red flag. We can see shares increasing, which is they're issuing new shares to get some money, which is not a horrible thing. I'm not saying it's the end of the world. I just mean as a shareholder, your dilution is one of the things I would be worrisome about. But if they have a good plan in place of what they're going to do with the money, and they're not just recycling it, giving it back to themselves. So that would be the only red flag I see so far. Price to sales, that has gotten cheaper over the years. One of the cheapest it's been in a while. Price to earnings, maybe on the low end. Not terribly expensive, but still quite a premium. Price to book, on average, it is lowest than it's been in a while, but still a little expensive. Come on down to return on invested capital. We can see 5% on average, I would say. Gross margin similar or better than McDonald's, I would say. Maybe the last year they're kind of in line together, but still 50-60% gross margin is quite good. Operating margin slowly decreasing over the last couple years, but 36%, 30%, 26% still. Quite a good operating margin. And even net margin, I want to say average 10%, a couple years, 14, 15, 17. Came down a little bit this last couple years, but with higher inflation and different economic factors, you can see a little bit of a slowdown in the spending of fast food, but I don't think even in an environment where, cost of living has gone up and inflation increases the price of goods sold, I don't think it really affects people wanting to eat out, needing a quick meal. Like I said, some of these restaurants, people have known since they were kids, so I mean, once they have kids, it's kind of I don't want to say a tradition, but I mean, it's something people are comfortable with. So, you can it never hurts to go get some McDonald's, or if you never feel like cooking, always get something to pick up quickly. But If I had to pick a winner, I don't know if I could pick a winner because they're all good in their own separate ways. You know, McDonald's, that massive giant that everybody knows, and I don't think is going anywhere anytime soon. You could see Wendy's as a possible rebounding opportunity. As we looked before, it's definitely came back, and looking at their revenue, they're actually in a quite good spot. So definitely a little more risk involved by buying Wendy's, but if you want a little bit of both worlds, you have the establish of the brands, but also still some room to grow, and that revenue increase is quite nice. So remember to always consult a financial advisor. Never listen to guys on the internet giving you financial advice, but I don't think you can go wrong with any of these. Remember to leave a like, comment what you think, and have a great rest of your day.